They tell you that building wealth after 40 is about patience, diversification, and trusting the long arc of compound interest. They say it's about time in the market, not timing the market. They are not wrong, but they are incomplete. The mathematical reality is far more specific, far more unforgiving, and far more actionable than the generic advice you've been fed. After 40, the system you operate within changes fundamentally. Your time horizon compresses. Your risk tolerance shifts, not because of emotion, but because of arithmetic, and the cost of a single catastrophic error becomes asymmetrically higher. Most people continue playing by the rules they learned in their 30 seconds, and that is precisely why they fail to build the wealth they need. The new rule is not about working harder or saving more. It is about understanding the mathematical structure of your remaining productive years and positioning yourself to exploit the specific inefficiencies that only someone at this stage can access. If this analysis allows you to understand wealth building with greater mathematical clarity and precision, subscribe now to continue this line of disciplined thinking. The first mistake people make after 40 is continuing to treat time as if it were abundant. It is not. Let us be precise about this. If you are 40 years old and plan to retire at 65, you have 25 years. That sounds substantial until you frame it correctly. 25 years is approximately 300 months, 1,300 weeks, 9,125 days. When you translate time into these smaller units, the psychological shift is immediate. You stop thinking in decades and start thinking in cycles. Each cycle, whether it is a market cycle, a product cycle, or a career phase, becomes a discrete event with measurable probability distributions. The emotional investor treats these 25 years as a monolithic block. The quantitative mind dissects them into tranches, each with different risk-return profiles, different liquidity needs, and different strategic imperatives. Consider the mathematics of compound growth. The classic formula is well known. Future value equals present value times 1 plus rate to the power of time. The exponential function rewards time. Double your time horizon, and you more than double your compounded wealth, assuming a constant rate. But here is the critical insight most people overlook. After 40, you do not have the luxury of assuming a constant rate. Your earning power, your health, your cognitive capacity, and the market environment itself are all variables subject to nonlinear decay functions. The rate of return you can generate from labor declines. The volatility you can withstand psychologically narrows. The buffer you have against tail events shrinks. This is not pessimism, it is probability. The second error is the failure to recalibrate risk in mathematical terms. Risk is not how you feel about volatility. Risk is the probability-weighted magnitude of permanent loss. Before 40, a 30% drawdown in your portfolio is recoverable because you have decades of earnings ahead. You can dollar cost average through the trough. You can rebuild. After 40, that same 30% drawdown represents not just a temporary paper loss, but a structural impairment of your wealth trajectory. The time required to recover from a 30% loss, assuming a 7% annual return, is approximately 5 years. At 45, losing 5 years to recovery is catastrophic. You have just converted 1/5 of your remaining horizon into a zero-sum recovery phase. The mathematics are brutal. A 50% loss requires a 100% gain to break even. Most people intuitively grasp this, but they fail to translate it into portfolio construction. They continue holding equity allocations designed for 30-year-olds, exposing themselves to drawdowns they cannot afford. The new rule after 40 is this: your allocation to risky assets must be a function not of your age, but of your maximum tolerable drawdown, multiplied by the time required to recover, discounted by your remaining productive years. This is not the traditional 60 to 40 rule or the age minus 100 heuristic. Those are crude approximations. The precise formula requires you to model your income stream, your fixed costs, your liquidity needs, and your psychological breaking point under stress. If you cannot withstand a 20% loss without altering your behavior, your equity allocation should be capped such that a 3 sigma market event, say a 40% equity crash, produces no more than a 20% portfolio loss. This is not timidity. It is engineering. Let us address the elephant in the room, real estate. After 40, many people assume their home is their primary wealth vehicle. It is not. Your home is a consumption asset disguised as an investment. Yes, it may appreciate. Yes, it provides utility. But it is illiquid, indivisible, and highly correlated with your local economy. If you lose your job in a recession, your home value likely declines simultaneously. That is not diversification. That is concentration risk masquerading as security. The mathematical reality is that real estate, when adjusted for maintenance, taxes, insurance, and opportunity cost, often underperforms a diversified portfolio of financial assets. The leverage embedded in a mortgage amplifies returns when prices rise, but it also amplifies losses when they fall. After 40, you must ask yourself, is my home equity working for me, or am I working for my home? If you have significant equity trapped in real estate, consider whether a strategic extraction, whether through refinancing, downsizing, or relocation, could redeploy that capital into assets with higher expected returns and greater liquidity. The third mistake is the failure to recognize that after 40, your human capital, your ability to generate income from labor, begins to depreciate. This is not ageism, it is actuarial reality. Your peak earning years are typically between 45 and 55. After that, age discrimination, technological disruption, health issues, and simple fatigue begin to erode earning power. The quantitative approach is to model your human capital as a bond. It has a face value, your expected lifetime earnings, a coupon, your annual salary, and a maturity date, your retirement. As you age, the duration of this bond shortens, and its sensitivity to interest rate changes, in this case, labor market shocks, increases. The implication is clear. After 40, you must actively hedge your human capital. If your income is tied to a single industry, say technology or finance, your portfolio should underweight that sector. If your income is tied to a specific geography, your investments should diversify globally. This is correlation management, not paranoia. Here is where the new rule becomes actionable. After 40, your primary objective is no longer growth maximization, it is wealth preservation with optionality. The difference is subtle but profound. Growth maximization chases the highest expected return, accepting commensurate risk. Wealth preservation with optionality seeks to protect the downside while maintaining exposure to asymmetric upside. This is the domain of convexity, of nonlinear payoffs, of strategies that lose small when wrong and win large when right. In practical terms, this means shifting from a barbell strategy, a core allocation, to low volatility, high quality assets, bonds, dividend-paying stocks, stable real assets, combined with a small allocation to high conviction, high volatility opportunities. The core protects you. The tail bets give you optionality. The worst outcome is the middle. Moderate risk with moderate return. That is the recipe for mediocrity after 40. Let us talk about cash. After 40, cash is not a drag. It is ammunition. The emotional investor sees cash yielding 3% and laments the 10% they could have made in equities. The quantitative investor sees cash as a perpetual call option on every asset class. When markets dislocate, when fear spikes, when volatility rises, cash allows you to act. It allows you to buy assets at distressed prices while others are forced to sell. The value of this optionality is immeasurable. Consider the mathematics. If you hold 20% of your portfolio in cash and the market drops 40%, your cash position is suddenly 33% of your portfolio. If you deploy half of it at the trough, buying equities at a 40% discount, and the market recovers to its prior peak, your portfolio outperforms those who were fully invested throughout the cycle. This is not market timing. It is systematic preparedness. The difference is that you do not predict the crash. You prepare for it. The fourth error is neglecting the role of taxes in wealth accumulation. After 40, taxes become one of the largest drags on your net returns. The difference between a 7% gross return and a 5% after-tax return is not 2%. It is the difference between doubling your money in 10 years versus 14 years. Over a 25-year horizon, that differential compounds into a 40% difference in terminal wealth. The quantitative approach is to treat tax efficiency as a first-order concern, not an afterthought. This means maximizing contributions to tax-deferred accounts, harvesting losses to offset gains, holding tax-inefficient assets like bonds and retirement accounts, and tax-efficient assets like equities and taxable accounts. It means understanding the difference between short-term and long-term capital gains and structuring your trading activity accordingly. It means considering Roth conversions in low-income years, when your marginal tax rate is temporarily depressed. These are not exotic strategies. They are basic arithmetic. Yet most people ignore them, effectively donating 20 to 30% of their returns to the government unnecessarily. Here is another dimension most people miss. After 40, your spending patterns become predictable, and that predictability is a mathematical advantage. Your fixed costs, mortgage, insurance, utilities, food, your discretionary spending, travel, hobbies, gifts. You can model these cash flows with reasonable accuracy. Once you have that model, you can construct a liability matching portfolio. This is the same approach pension funds use. You identify your future liabilities, discount them to present value, and build a portfolio of assets whose cash flows match those liabilities. For a 40-year-old, this might mean laddering bonds or dividend-paying stocks to provide income in 10, 15, 20 years. The beauty of this approach is that it immunizes you against interest rate risk. If rates rise, your bond prices fall, but your reinvestment income rises. If rates fall, your bond prices rise, but your reinvestment income falls. The net effect is stability. This is not exciting. It is not the stuff of get-rich-quick fantasies, but it is the mathematics of security. Let us address a more uncomfortable truth. After 40, many people are not building wealth because they are still servicing the debts of their youth. Student loans, credit card debt, car loans, these are anchors. The interest rates on these debts are often higher than the returns you can reasonably expect from investments. Paying off a credit card charging 18% interest is mathematically equivalent to earning an 18% return, risk-free. There is no investment strategy that can compete with that. The new rule is simple. Before you invest another dollar, eliminate high-interest debt. This is not moralizing. It is optimization. Debt is negative leverage, and after 40, you cannot afford to be leveraged in the wrong direction. Another critical element is understanding the role of volatility. Volatility is not risk, but it is a proxy for risk in most models. After 40, your ability to tolerate volatility declines, not because you become more emotional, but because the math changes. Consider two portfolios, one with a 7% average return and 15% volatility, another with a 6% average return and 5% volatility. The first portfolio has a higher arithmetic mean, but the second portfolio may deliver superior compound growth because it experiences fewer large drawdowns. This is the difference between arithmetic and geometric returns, volatility drag. The difference between the two is a function of variance. The formula is geometric return equals arithmetic return minus 1/2 times variance. The higher the volatility, the greater the drag. After 40, minimizing volatility is not about fear. It is about maximizing compound growth. Here is where discipline becomes everything. The emotional investor after 40 panics during downturns and sells at the worst possible time. The quantitative investor has a pre-written algorithm. If the portfolio drops by X%, rebalance by selling bonds and buying equities. If it rises by Y%, do the reverse. This removes emotion. It enforces discipline. It is systematic. The most successful investors after 40 are not the ones with the highest IQs or the best market instincts. They are the ones with the most disciplined execution. They are the ones who treat investing as a system, not a series of bets. Let us also discuss the importance of earning power in later life. After 40, many people assume their career trajectory is set. This is a dangerous assumption. The half-life of skills is shrinking. What you knew at 30 may be obsolete at 50. The new rule is continuous reinvestment in human capital. This means learning new skills, staying relevant, building networks, and remaining adaptable. The mathematics is straightforward. If your earning power declines by 3% per year after 50 due to obsolescence, and you do nothing to counteract it, your lifetime earnings are reduced by 30% over a decade. But if you invest 10% of your time in skill upgrading, you can flatten or even reverse that decline. This is not career advice. It is portfolio management. Your human capital is your largest asset. Treat it accordingly. Another overlooked factor is health. After 40, health expenses begin to rise, and health shocks can devastate financial plans. The quantitative approach is to model health as a risk factor with a fat tail distribution. Most years, expenses are modest, but in a few years, they spike catastrophically. The hedge is insurance and reserves. Max out health savings accounts, if available. Build a dedicated health emergency fund. Understand your insurance coverage and its limits. A $50,000 medical bill at 50 can derail a decade of wealth building if you are not prepared. This is tail risk management applied to personal finance. Now, let us talk about the psychological dimension, but from a quantitative perspective. After 40, most people experience what psychologists call present bias more acutely. The future feels distant, the present feels urgent. This bias leads to undersaving and overspending. The mathematical solution is to automate. Set up automatic transfers from checking to investment accounts on payday. Remove the decision from the present bias self and delegate it to the system. Behavioral economics shows that people consistently undersave when saving is optional and consistently meet savings goals when saving is automatic. This is not willpower, it is system design. Here is another truth. After 40, social comparison becomes more dangerous. You see peers buying larger homes, newer cars, taking expensive vacations. The pressure to keep up intensifies. But wealth is invisible. The neighbor with the luxury car may be drowning in debt. The colleague with the beach house may have no retirement savings. The quantitative mind ignores these signals. It focuses on one metric, net worth trajectory. Are you on track to meet your financial independence number? If yes, external comparisons are noise. If no, adjust. This is not asceticism. It is clarity. Let us address asset allocation more precisely. The traditional advice is to hold your age in bonds. At 40, that means 40% bonds, 60% equities. This rule is crude and often wrong. The correct allocation depends on your specific risk tolerance, income stability, spending needs, and time horizon. A better framework is the liability-driven approach. Calculate your essential spending, the minimum income you need to maintain your lifestyle. Build a bond ladder or annuity structure to cover that. Everything beyond that threshold can be allocated more aggressively because it is surplus, not essential. This creates a safety net while preserving upside. It is the financial equivalent of a two-stage rocket. The first stage gets you to orbit, the second stage lets you explore. Another key insight. After 40, diversification must be tactical, not just strategic. Strategic diversification is broad: stocks, bonds, real estate, commodities. Tactical diversification is dynamic, adjusting exposures based on changing correlations, volatility regimes, and valuation metrics. For example, in a low-rate environment, traditional bonds offer little protection. In that regime, consider alternatives: gold, inflation-protected securities, or short volatility strategies. The point is not to predict the future, but to ensure your portfolio adapts to the present regime. This requires monitoring, rebalancing, and discipline. It is active management, but not in the sense of stock picking. It is regime awareness. Let us also consider the role of side income. After 40, many people have skills, networks, and experience that can be monetized outside their primary job. Consulting, freelancing, teaching, creating digital products, these are streams that diversify income, risk, and extend earning years. The mathematics are compelling. An extra $1,000 per month invested at 7% for 20 years is $520,000. That is not a trivial sum. The new rule is to treat your career not as a single income stream, but as a portfolio of income streams. Diversify your revenue sources, reduce dependence on any single employer or client. This is risk management applied to labor. Another dimension, estate planning. After 40, mortality becomes statistically non-negligible. The quantitative approach is to model it, use actuarial tables, calculate your life expectancy, then ask, if I die tomorrow, what happens to my wealth? Do I have adequate life insurance? Is my estate plan clear? Are my beneficiaries designated? These are not morbid questions. They are probabilistic planning. A $1 million term life insurance policy costs perhaps $1,000 per year for a healthy 40-year-old. That is a 1,000 to 1 leverage on catastrophic risk. There is no investment with that payoff structure. This is not about fear, it is about mathematics. Here is a critical truth most people miss. After 40, the goal is not to maximize wealth in isolation, but to maximize utility, the satisfaction derived from wealth. Utility is not linear. The difference between $0 and $500,000 is life-changing. The difference between $5 million and $10 million is marginal. This is diminishing marginal. Utility. The implication is that beyond a certain threshold, taking excessive risk to accumulate more wealth reduces expected utility. You are risking the life-changing for the marginal. The quantitative investor identifies that threshold and stops taking unnecessary risk once it is reached. This is not laziness. It is optimization. Let us also talk about behavioral traps. After 40, confirmation bias intensifies. You have decades of experience, and you believe you know how markets work. But markets evolve. What worked in the 1,990 seconds may not work today. The quantitative approach is to remain a perpetual student. Update your priors, test your assumptions, be willing to admit you were wrong. The moment you stop learning is the moment your edge erodes. This is epistemic humility, not weakness. Another overlooked factor, geographic arbitrage. After 40, many people are locked into high-cost geographies due to jobs, family, or inertia. But if you have flexibility, moving to a lower-cost area can dramatically accelerate wealth accumulation. The difference between living in San Francisco and living in a mid-tier city can be $50,000 per year in after-tax savings. Over 20 years, that is $1 million before investment returns. This is not about lifestyle sacrifice. It is about strategic relocation. The mathematics are undeniable. Let us address another uncomfortable reality. Many people after 40 are not building wealth because they are subsidizing adult children, paying for college, supporting unemployed adults, funding weddings. These are wealth transfers that impair your own security. The quantitative approach is ruthless. Your financial independence comes first. You cannot help others if you are not secure yourself. This is not selfishness. It is the oxygen mask principle. Secure your own oxygen before assisting others. Set boundaries. Teach financial independence rather than dependence. Here is another critical insight. After 40, time diversification becomes limited. Time diversification is the idea that over long horizons, equity risk diminishes. This is true in expectation, but not in reality. A lost decade in equities, say 2000 to 2010, can devastate a 50-year-old's retirement plan in ways it would not harm a 25-year-old. The quantitative approach is to recognize that you may not have time to recover from a prolonged bear market. Therefore, your portfolio must be constructed to survive that scenario, not just to optimize for the average case. This is tail risk management, not pessimism. Let us also discuss the importance of mental models. After 40, you have seen enough market cycles to develop intuitions, but intuitions are often wrong. The quantitative investor replaces intuition with models. A model is a simplified representation of reality that generates testable predictions. For example, a simple model might be, when the yield curve inverts, equities tend to underperform over the next 18 months. This is not a guarantee, but it is a probabilistic edge. The discipline is to follow the model even when your intuition says otherwise. Over time, models win. Intuitions, no matter how experienced, are polluted by recency bias, availability bias, and overconfidence. Another key principle, after 40, liquidity becomes more valuable. Illiquid investments, private equity, real estate partnerships, hedge funds, often promise higher returns, but they lock up your capital. If you face an unexpected expense or a market dislocation, you cannot access that capital without significant cost. The quantitative approach is to value liquidity explicitly. An illiquid investment must offer a premium of at least 3 to 5% per year to justify the loss of optionality. Often, it does not. The new rule is to favor liquidity unless the illiquidity premium is mathematically compelling. Let us address another dimension, the role of mentors and networks. After 40, your network is established, but it may have ossified. The quantitative investor actively seeks new perspectives, younger colleagues, different industries, contrarian thinkers. This is informational diversification. It prevents you from becoming trapped in an echo chamber. It exposes you to new ideas, new opportunities, new risks. This is not networking in the social sense. It is information arbitrage. Here's a truth that few discuss. After 40, the probability of divorce, health crisis, or career disruption is non-trivial. These are tail events with catastrophic financial consequences. The quantitative approach is to stress test your financial plan. Run scenarios. What if I lose my job? What if I get divorced? What if I need long-term care? If your plan collapses under any of these scenarios, it is not a plan, it is a hope. Build buffers, diversify, hedge. This is scenario analysis, not paranoia. Let us also talk about the role of passion and purpose after 40. Many people feel they must pursue wealth for its own sake, but wealth is a means, not an end. The quantitative investor asks, what is the minimum wealth I need to achieve my goals? Once that threshold is identified, additional wealth accumulation is optional. You can take risks for passion projects, for impact, for meaning, because your baseline security is assured. This is not romantic. It is strategic. Wealth buys optionality, and optionality buys freedom. Freedom is the ultimate goal. Another overlooked factor, after 40, the cost of mistakes rises exponentially. A bad investment at 25 is a lesson. A bad investment at 50 is a disaster. The quantitative approach is to become more conservative in your risk budget, not your ambitions. You can still pursue high return opportunities, but you must do so with smaller position sizes, better diversification, and tighter stop losses. This is not cowardice. It is survival mathematics. Let us address the role of inflation. After 40, inflation is not an abstract concern. It is a direct threat to your purchasing power. If inflation averages 3% per year and your investments return 6%, your real return is only 3%. Over 25 years, the difference between a 6% nominal return and a 3% real return is enormous. The quantitative investor explicitly hedges inflation through assets that benefit from rising prices. Real estate, commodities, inflation-protected bonds, equities in sectors with pricing power. This is not speculation. It is purchasing power preservation. Here is another key insight. After 40, the compounding of small advantages becomes dominant. A 1% higher return, a 1% lower fee, a 1% better tax efficiency. These do not sound significant, but over 25 years, they compound into 30% differences in terminal wealth. The quantitative investor obsesses over these small edges. Minimize fees, optimize taxes, rebalance systematically, avoid behavioral errors. These micro-optimizations are the difference between success and failure. Let us also discuss the importance of frugality. After 40, many people inflate their lifestyle in proportion to their income. This is lifestyle creep, and it is mathematically destructive. The quantitative approach is to fix your lifestyle at a level that provides satisfaction and invest every incremental dollar of income. If your income rises from $100,000 to $150,000, live as if you still make $100,000 and invest the $50,000. Over time, this discipline creates exponential wealth growth. This is not deprivation, it is intentionality. Another critical truth, after 40, your biggest enemy is complacency. You have achieved a certain level of success, and it is tempting to coast. But the world is dynamic. Markets change, technologies disrupt, competitors emerge. The quantitative investor remains vigilant. Monitor your portfolio, update your models, stay informed, adapt. This is not paranoia, it is continuous improvement. Here is the ultimate truth. After 40, wealth building is not about luck or timing. It is about system design. You design a system that minimizes downside, maximizes compounding, and adapts to changing conditions. You execute that system with discipline, without emotion, without deviation. You trust the mathematics, not the headlines. You focus on what you can control: savings rate, asset allocation, tax efficiency, risk management. You ignore what you cannot control: market returns, economic cycles, geopolitical events. This is the quantitative mindset. This is the new rule. Remember, this content is educational and does not constitute financial advice. Its purpose is to help you think from a quantitative and mathematical perspective. The markets are indifferent to your age, your hopes, your fears. They reward discipline, preparation, and systems. After 40, you do not have the luxury of time to recover from errors. Every decision must be deliberate. Every allocation must be justified. Every risk must be measured. This is not a game. It is a mathematical problem with a solution. The solution is a system. Build it. Execute it. Trust it. The data does not lie. The market is simply a reflection of collective behavior. And collective behavior, when observed with sufficient rigor, is predictable. Apply the logic, trust the math, and the results will follow.